Over my many decades in the market, I've seen the same patterns repeat themselves. The euphoria, the greed, the fear, it's all happened before, and right now, I'm seeing signs that remind me of what always happens. Just before a market crash, most people don't see it coming. They get caught up in the excitement, the easy money. But if you pay attention to history, the warning signs are always there. And if you recognize them, you can protect yourself. Maybe even profit when others panic. So, let me tell you what I've seen before every major crash, and what you should watch for today. When people start believing stocks only go up, when your barber, your Uber driver, even your neighbor is giving stock tips, that's a warning. Markets don't climb forever. Greed blinds people to risk. Price matters. When stocks trade at levels far above their historical averages, gravity eventually takes over. The dot-com bubble, the 2008 housing boom. Each time, valuations scream danger today. We're seeing similar extremes. Asterisk, when borrowing to invest becomes the norm, the fall gets uglier. Too much leverage means forced selling when markets drop, and that turns dips into disasters. Very bubble has its excuse. New economy, no more recessions. The Fed has our back, but history doesn't care about excuses. When everyone ignores risk, risk doesn't ignore them. Watch what the seasoned investors do, not what they say. If insiders are selling while the public is buying, take note. I've always said be fearful when others are greedy. And right now, there's a lot of greed. Now, I'm not saying a crash is tomorrow, but when these signs line up, the wise move is to prepare, hold cash, stick to quality, and most importantly, don't follow the crowd off the cliff. Remember, the market's job is to transfer money from the impatient to the patient. Stay smart, my friends. You can feel it in the air. The excitement, the rush, the belief that every dip is just another buying opportunity. People start throwing money at anything with a ticker symbol, convinced that the good times will never end. They forget the most basic rule of investing. Markets move in cycles. When taxi drivers and college kids are swapping stock tips like they're seasoned pros, that's not a sign of wisdom. It's a sign of speculation. The problem isn't enthusiasm, it's blind enthusiasm. When prices detach from reality, when companies with no earnings trade at astronomical valuations, that's not investing. It's gambling. And history has a way of humbling gamblers. The smartest thing you can do in these moments, step back. Ask yourself, would I still buy this if the market closed for 5 years? If the answer isn't a clear yes, you might be caught in the frenzy. There's an old saying, the market takes the stairs up and the elevator down. When everyone's piling in, the exit gets crowded fast. Best opportunities often come when others are running for the doors, not when they're rushing in. The key is patience, waiting for the right pitch instead of swinging at everything. Greed clouds judgment. When you hear people talking about easy money, that's usually when the hard lessons begin. The market doesn't reward recklessness forever. Sooner or later, fundamentals matter again. And when they do, the unprepared pay the price. Numbers don't lie. When stocks trade at levels far beyond their historical averages, it's not a new paradigm. It's a warning. Markets have memory. They tend to return to their long-term trends, no matter how much people insist this time is different. When the price-to-earnings ratios stretch into the stratosphere, when companies are valued at 50, 100 times earnings, that's not growth, it's speculation. The danger isn't just that prices are high. It's that people start justifying them with flawed logic. This company will dominate the future. Traditional metrics don't apply anymore. Sound familiar? It should. Those were the same excuses heard in 1999, in 2007, and in every bubble before that. The truth is simple. No tree grows to the sky. Eventually, gravity wins. The smart move, focus on value. Look for businesses trading at sensible prices relative to their earnings, cash flow, and growth potential. The best investments aren't the ones making headlines. They're the ones quietly compounding wealth over time. When the crowd chases hype, the disciplined investor finds opportunity in what's overlooked. Markets can stay irrational longer than you can stay solvent, but they don't stay irrational forever. When valuations disconnect from reality, the correction is never gentle. The higher they climb, the harder they fall. And when they do, the ones left holding overpriced assets are the ones who forgot the oldest rule in finance. Price is what you pay, value is what you get. Nothing amplifies gains like borrowed money, and nothing magnifies losses like it, either. When investors start using margin debt to chase returns, that's not confidence. It's overconfidence. Leverage works great on the way up, but on the way down, it turns small setbacks into disasters. The market doesn't care how much you borrowed. It will take everything. The signs are always the same. Easy credit, relaxed lending standards, people taking out second mortgages to buy stocks. It happened in 1929, in 2000, in 2008, and it's happening again. When debt fuels speculation, the reckoning is inevitable, because when prices start falling, margin calls for selling, which pushes prices down further, which triggers more selling. It's a spiral, and the ones who survive are the ones who didn't play with fire. The best investors treat leverage like dynamite, useful in the right hands, catastrophic in the wrong ones. If you wouldn't bet your house on a single stock, why bet borrowed money? The market humbles the overleveraged every time. The smartest players keep cash, stay patient, and let others make the reckless bets. Debt doesn't just increase risk, it removes options. When you're all in with borrowed money, you can't wait out the storm. You're at the mercy of the market's mood swings, and the market has a cruel sense of humor. The greatest investors win not because they take the biggest risks, but because they survive the worst downturns. And survival starts with avoiding debt traps. Every bubble has its story. The old rules don't apply. Technology changes everything. Central banks won't let markets fall. The phrases change, but the mindset doesn't. People convince themselves that this boom isn't like the others, until it is. History doesn't repeat, but it rhymes, and the melody is always the same: denial, euphoria, panic. The problem isn't optimism, it's selective memory. People remember the gains but forget the crashes. They focus on the exceptions, not the rules. Markets have cycles. Booms lead to busts. Excess gets punished. These aren't opinions. They're facts written in the history books over and over. The moment people dismiss them is the moment risk creeps in. The best defense, skepticism. When everyone's nodding in agreement, that's when you should ask the hard questions. What if the consensus is wrong? What if the risks are being ignored? The crowd is usually right in the short term, and dead wrong at the extremes. The biggest fortunes are made by those who see the cracks before the dam breaks. The market doesn't care about narratives. It doesn't matter how convincing the story is. If the math doesn't work, the math doesn't work. The smartest investors know that the four most expensive words in finance are, "This time is different," because it never is. Watch what people do, not what they say. When corporate insiders are selling their own stock while telling the public to buy, that's not a coincidence. It's a signal. The ones who know the business best are often the first to head for the exits. And when the so-called smart money starts cashing out, it's worth paying attention. The signs are subtle but telling. CEO quietly unloading shares, hedge funds raising cash, legendary investors trimming positions. They're not making headlines, they're making moves. The crowd cheers the rally while the experienced prepare for the turn. The difference: one group is thinking about today, the other is thinking about tomorrow. The best investors are contrarians by nature. They don't follow the herd, they watch it. When everyone's buying, they're asking, who's left to buy more? Markets top out when the last buyer has finally jumped in. And by then, the smart money is already gone. There's no bell that rings at the top, but there are clues if you know where to look. The biggest moves happen when the crowd least expects them, and the ones who profit are the ones who position themselves early. Because in the market, the early bird doesn't just get the worm, it avoids the trap. So, what do we do with all this? Do we panic? Do we run for the hills? No, that's not how the game is won. The best investors don't predict crashes. They prepare for them. They keep their heads when others lose theirs. They buy when there's blood in the streets, even if it's their own. Markets will always have cycles. Booms, busts, fear, greed. They're part of the journey. The key isn't timing the market. It's time in the market, on your terms. Buy wonderful businesses at fair prices. Hold cash when others are reckless, and never forget. The market is a device for transferring money from the impatient to the patient. Stay smart, stay patient, and when the storm comes, and it will, you won't just survive. You'll thrive. Be greedy when others are fearful, you see. The greatest lesson the market teaches us isn't about picking stocks or timing cycles. It's about understanding human nature. Greed and fear have driven markets for centuries, and they'll continue to do so long after we're gone. When I look at today's market, I don't see numbers and charts, I see people. People making the same mistakes, falling for the same traps, and ignoring the same warning signs that investors have ignored for generations. The irony, the solution isn't complicated. It never has been. Buy wonderful businesses at sensible prices. Hold them for the long term, and most importantly, keep your head when others are losing theirs. Time is the friend of the wonderful business, but the enemy of the mediocre. In these moments of excess, that lesson gets forgotten. People chase quick gains instead of sustainable wealth. I'm often asked what keeps me up at night. It's not market crashes, those are inevitable. What worries me is watching good people make bad decisions because they've been swept up in the frenzy. Markets operate like dominoes. The first one tips when nobody expects it, then another and another, until suddenly everyone wonders how they didn't see it coming. But here's what most won't tell you. Every crisis contains opportunity. The same market that takes away also gives to those prepared with cash, courage, and calm judgment. I've lived through 17 recessions. Each one felt different in the moment, but looking back, they all followed the same script. The names change, the patterns don't. So as you watch these events unfold, remember this isn't about predicting the next crash. It's about being prepared regardless of what comes. That's how real fortunes are built, not overnight, but over decades. Price is what you pay. Value is what you get. Fade to black as piano music resolves. Stay patient. Stay disciplined. And most of all, stay rational. The market rewards it more often than not.